All right, everyone's hair looks good. So let's get that out of the way. Ladies and gentlemen, thanks so much for stopping by the State of Crypto M&A. M&A, my favorite topic of the week after metaverse. Maybe we can touch on that as well. But we have luminaries from across the space. We have Shan Aggarwal at Coinbase, Lane Kasselman at blockchain.com, Michael Ashe joining us from Galaxy, and Steve McNew at FTI Consulting. Gentlemen, there's a lot going on. As a matter of fact, one of our participants had made an acquisition late last night. So clearly things are ramping up. But let's start broad, and then we can work our way into the thorns. Everyone has their eyes on this space from across the market, thinking about ways they can break into crypto, offer services in this market. There's a lot of VC money pouring into the space. What is the state of crypto M&A right now? Is it hard because of the bull market to make a deal, or easy because of the bull market to make a deal? Maybe we'll start with you, Michael.
Yeah, Frank, it's great to be here, and appreciate you having us. Look, I think right now we're seeing a couple of things, right? The bull market has been really incredible for companies in the space for a couple of reasons. One, the influx of capital that we've seen over, the better part of this year, even the end of last year, has, I think, done a couple of things from an M&A perspective. One, it's made, currencies, that much more, and by currency, I mean with the equity, that much more attractive from a consideration perspective. So it's much easier as a buyer to use your stock for consideration. It also means that a bunch of companies today are sitting on large piles of cash, right? So at the end of the day, what that means is, and we're seeing it today, like a number of the larger companies that are cash rich, that are sitting with highly attractive stock, are out there actively looking, to make acquisitions, whether they're going to grow geographically, they're going to grow by product, they're going to look to bring in engineering talent. I mean, that's something that we're seeing across the board, if for no other reason than, it's hard today to build your engineering teams as quickly as the market is requiring it. We're certainly seeing a number of companies out there look to grow via acquisition, and really, bolster their talent, bolster their engineering teams in that way. Look, I think generally speaking, for smaller companies, there are still companies out there today that are actively looking at potentially as M&A as an exit, right? It is certainly not the case that capital is available to everyone. There are companies who, maybe aren't as far along from an adoption perspective. They've got tech, they've got product, but maybe the market hasn't quite moved there yet. And so we're seeing it today on a daily basis, candidly. More and more companies are coming together from an M&A perspective. And our expectation for the foreseeable future is we're going to see that continue to accelerate.
Shan, when we spoke last week, we talked about this question of whether or not the frothiness or the amount of capital flowing in VC land is making it more difficult for firms like Coinbase to snap up companies, even though you have that stock, that M&A currency, if you will. Companies can go get valued higher in the private markets.
Yeah, no, absolutely. I think on one hand, like Michael mentioned, the bull market has benefited a lot of the companies that have been in the crypto space now for some time. But on the other hand, in 2021, the cat has sort of come out of the bag about Web3. And so we see a broader universe of acquirers that are interested in looking at potentially snapping up some companies in the space. And then the funding environment has also heated up. And so if you're an entrepreneur or a founder, you have more options and more alternatives. And so I think you really have to ask yourself sort of what is the long-term vision that you have for the business. For us as acquirers, we still find that the best acquisitions and best companies that we end up working with, we tend to have long-term strategic alignment around our vision. And so it makes more sense for us to join forces, but it has become a lot more difficult in many ways.
Lane, I know you have a pipeline of companies or a pipeline of deals in the works. Walk us through maybe what the discussions look like at the table right now.
Yeah, Frank. Well, I think there's a couple of things that are true in the M&A space in crypto. Coming up with a good idea isn't hard. I'm sure a lot of people on the call right now have great ideas for what to do in crypto. Building a team and getting money to invest in that idea, not super hard, right? We're seeing lots of investment in the space right now for almost any idea. What's hard is finding customers. And crypto is not new anymore, right? The sector's been around for over a decade, which means there's a lot of walking dead. And so you call it in VC land, right? The types of companies that had a good idea, maybe had a team, but just couldn't find product market fit. And so if you're in the, the aisle of the M&A Walmart, there's a lot on the shelves right now. There's a lot to choose from. And we're actively shopping and looking for them. There's plenty of deal flow coming in. But to your point earlier, it's pretty frothy right now. And so you have to be careful about what you're looking for. Some of these prices are a little outrageous, but there are a lot of really good teams to buy, a lot of good products to buy.
Steve, you kind of come at this from the perspective of a consultant, advisor, financial advisor in a sense for companies that might be wanting to make a deal in crypto. How are you navigating them through this environment of excess?
Yeah, I think first of all, thanks for having me. It's great to be here with everyone. I think what Lane just said really resonates, right? That there is such a demand that we see lots of companies in the space, and you have to be really careful about where you're investing your money. Not only because it's easy to have an idea, it's easy to get funding, but and not only is it hard to get to market and get customers, but for those that do have success in that space, it's even harder for them to have a sustainable plan, to have a mature business model with a long-term vision and a long-term strategy. And that's one of the things that we see the most is such an appetite to acquire and invest, having to reconcile that with an inability of the company to prove out all of the assumptions that went into the business model for their 5-year projection, for example, or their 3-year projection. Their ideas are mature. The business model isn't always necessarily the same.
And how do tokens impact these deal structures when you're looking at an opportunity in the market? This is an additional consideration that doesn't really exist in other areas of the market. We talked about this, Steve, last week. How are companies, maybe companies that are outside of crypto looking to acquire from within, getting more comfortable with crypto tokens specifically as a consideration in the mix?
I think the more they go mainstream, the more likely you have education, not always great education, but people are becoming more familiar, they're becoming more aware. And then the challenge becomes, and I think it was, I can't remember who mentioned this earlier, but somebody said something about making sure it's a strategic fit, right? I think that's an important component of this too, right? If you're buying a business just because they have a token and it's cool and it's the new hot thing, are you blindsided by that and not thinking about the long-term implications of that business model? And what are the regulatory considerations that you have to consider as well? What are the technical considerations that you have to consider? So I think there's a lot that goes into that. It's certainly more interesting than the exchanges and other platforms that are a little more straightforward when you have a token involved.
Michael, how does it impact the models specifically for a deal?
Look, I think when we think about tokens, one, I think Steve's right. It's all about education, right? And ultimately, when we think about tokens, we really think about the utility of that token, right, with regard to whatever that pro forma business actually looks like. So, is there really a true use case for that token, or like Steve said, is it more novel, right? And so, if there really is a use case, look, I think it's our job to figure out how to incorporate that into the financial model of some sort. There isn't a one-size-fits-all answer to that. I think it's really on a case-by-case basis. It is, again, very much utility-driven in the way we think about it. I mean, the one thing that we've seen continue, to be prevalent from a token perspective is using tokens as consideration for M&A, right? And so, a crypto company sitting on a balance sheet with a treasury of tokens, being able to actually, use that as a piece of the overall pie that they're going to pay for that, for whatever business they're acquiring it. And so, things like that come into play from a working capital perspective when you're really going through the nuts and bolts of the M&A process. But it's definitely something that I think we all need to be mindful of. But again, it's really education, and it's going to be very specific to the actual utility of that token and the use case for that business going forward.
I think it's something that people are becoming more comfortable with, and it's increasingly becoming an important part of some of these deals. If you even think about your own acquisition of Bitco, right? There was a lot of Bitcoin sitting on that balance sheet. That's a consideration for the acquiring company. There was also the SPAC deal with the EOS-backed exchange, Bullish, right? We're talking billions of dollars worth of crypto sitting there on the balance sheet. So it's something that's becoming more important. It's one of the several dynamics shaping M&A today. What's interesting is Coinbase, and Shan, you've kind of sat in a seat at the firm for several years in corporate development and got to see different cycles play out. When you think about the juxtaposition of this bull market and the bear market of maybe, let's say, 2018, you guys are snapping up companies left and right. I think I saw a stat from CB Insights, 20 this year or more. You can correct me if I'm wrong. Is this a better time than maybe in years past, and what dynamics have changed from your seat?
I think like our business has just grown so much and has gotten increasingly more complex, right? And so when we think about the types of companies that we're trying to acquire, it all aligns to our product strategy and our product roadmap. And so as our business has grown, our appetite for M&A to accelerate our product goals has grown. And so I expect that will be prevalent across the industry, particularly as we see multiple bull cycles over the near future. Relative to the bear market and now, I would say from a timing perspective, there's different dynamics, I think, now than there were at that point. At that point, the Web3 seemed a little bit less obvious, I think, and now it seems a lot more obvious to more folks. And so I think it's a lot easier now to take a longer term purview on the space overall. And so it'll be interesting to see if and when the market turns, if we see some of those dynamics that played out in 2018 play out again, or if folks are willing to sort of ride out those valleys, if you will, for the next peak.
How do you think it's changed, Lane? And by the way, those are venture deals that I was thinking of. You haven't made 20 acquisitions this year, but maybe you could. We still have a few months left in the year.
Well, and to the point, Frank, and I think you and I talked about this, I don't know, a month or so ago, but if you think about the overall startup ecosystem, right, and that's where I come from, 10% of early stage startups are focused on crypto. So if on average, 30% of all early stage startups get acquired, and there's 8,000-ish startups that'll get funded this year, then we've probably got another 120, 130 to go before the end of the year. And just based on what we're seeing in the market, deals, and I'm sure, Shan, you've experienced this, like deals will kind of sputter along throughout like Q2 and Q3. And then everybody's just jamming it to try and get them done in Q4. So I do think we'll see a ton of things closed by the end of the year, because of course people want to have it closed out before the beginning of next year. So I do think the market, it's not, if you feel like maybe there's a lull or it's a little quiet, we're about to be, I think, fascinated with the number of acquisitions that close by the end of December.
Steve, or go ahead, Shan. Yeah.
I was just going to say, I fully agree with Lane. It's kind of one of those, I find almost misperceptions about M&A. Companies don't just wake up one day and start buying companies. It sort of takes time to pull together all of the teams, think about what the strategic goals are, identify the right target, and then actually consummate a deal. And so by the time you sort of align as a team around investing in that as a lever to grow the business, it takes months, sometimes quarters, for them to bear fruit. And so I agree with Lane that I think that over the next few quarters, you'll see quite a bit announced.
So, Steve, is this a calm before the storm?
100%. I believe that to be true. And I think it's true across the board, too. We've seen a massive uptick in businesses adding capabilities, acquiring to enhance capabilities, investors investing in the space. I think across the board, it's the tip of the iceberg for sure.
One thing that we've noticed or haven't yet seen are there are a few exceptions. I think Citi's done a few deals, but the large investment banks haven't really been playing that outsized of a role in some of these larger crypto transactions. Do they really bring anything to the table that's useful? I mean, do they have the expertise? Have they cut their teeth enough to add value in a deal? Maybe we can get Lane's perspective.
Yeah, I mean, look, I think a lot of folks will ask, what are the things that keep you up at night, right? What are the existential threats? And it's not, my friends across the street, at Shan's firm at Coinbase, like we're contemporaries, right? We're building the industry together. It's the banks, right? And so far, the slumbering giants haven't really woken up to the space, but we're starting to see them dabble in it. In Miami, we share office, our building with JP Morgan and with BNY Mellon, and they're both, signaling that they're starting to get much more interested in the space. I think it's going to take a while before their shareholders give them the green light to start spending billions of dollars on major acquisitions. But I don't think it's an F, it's a win, right? We'll see some major contemporaries in the space get swallowed up by some of the biggest banks in the world. And it may not be a US bank, right, or a US based bank. Much more likely it'll be a European or Latin American bank that swallows up a major broker. But I think it's coming soon, not like 3 years soon, like 12 months soon.
And Frank, to Lane's point there, just so I can cut in real quick. I mean, we're already seeing those large banks show up on cap tables, right? And so you're starting to see some of the more mature companies, like in Series B, Series C. You're starting to see Citi, you're starting to see JP Morgan and others kind of find their way into the space. And so I think Lane is absolutely spot on. I mean, we are starting to see them dip their toes in, via investment. But I completely agree. At some point there, and again, I think it's sooner than later, we're going to see, acquisition be a primary means of them enhancing their product offering. I think they all recognize today that crypto needs to be a part of their near-term roadmap. The question ultimately, I think, for them is, their risk tolerance per se might be a bit different, from what they perceive the industry to be today. And so ultimately, it's a matter of marrying their risk tolerance to what they believe the risk is in the space for them to actually dive in and make a significant acquisition.
There's quite a number of folks listening in who work at some of the banks we mentioned. I'm not going to call you out. So I want this to be a safe place for you fine investment bankers. But we have seen, we've seen a preview of traditional financial services firms acquire companies in the crypto space. CBOE's acquisition of ErisX provides one example. There was also MasterCard's acquisition of CipherTrace. When we think about the next 6 months, maybe who's going to be driving M&A? When I spoke with Lane and Shan for that piece I wrote a couple months ago, I got the sense that it was going to be the large crypto financial services shops. But maybe in 2022, will it be the TD Ameritrades of the world, et cetera? I will direct that question to Steve.
I don't know about the timing of it. I do think inevitably it's true. I just don't know how quickly. We work with a lot of the big banks, and we see them struggling with this space from a number of different angles, right? Regulatory concerns, capabilities concerns, shareholder approval and buy-in. I also think you see a lot of the banks dabbling and trying to figure out how to fit crypto into their traditional business process flow. And I think as they consider that and they stumble on all of the challenges related to that, the appetite to buy versus build gets better. And I think we'll start to see that tipping point in the coming year. How meaningful that is, I'm not clear yet. I think some of that has to do with some of the regulatory concerns that are still outstanding. But I find it really interesting when a bank calls and says, we're really struggling to get this payment to go through quickly enough because it has to go through all of these protocols that we've done for 100 years. And we're not able to make crypto function in the same way without losing its advantages for our consumer. And so how do we do that? And it's like, well, you can't take this new technology and this new instrument and treat it the same way that you have currency for 100 years. You have to look at it like it is, a revolutionary new approach. And I think that's very difficult for them.
So I think we've done a good job picking digging into some of the different themes that are shaping the market right now. I want to zoom in and approach the conversation from a micro level, what it actually looks like inside these deals. Shan, when we spoke, you talked about Coinbase's approach to basically assigning a grade for each transaction. Can you walk us through how that process works and what the philosophy is behind it?
Yeah, maybe I guess just at the backdrop, I think, Frank, you're referring to sort of how do we measure success in these transactions, right? And so, earlier I mentioned companies don't just wake up one day and say, hey, we want to, acquire companies. It all starts with setting out, well, what are the goals, the strategic goals for that transaction? And so we will have fairly clear success criteria or success metrics that are identified and outlined for every transaction. Before we'll submit an LOI to acquire that business. And then we will typically have various checkpoints once we actually end up executing that transaction, where we will do a look back based on those success metrics. And we will measure, are we 90% complete, 70% complete, or did we completely miss the mark? And we don't expect that we will get all acquisitions right and hit all of our success metrics. And that's part of the kind of continuous learning ethos that we have here at Coinbase. But those are great learning moments for us on the next one.
Is it a similar process at blockchain, Lane?
Yeah, I mean, we tend to focus on 3 target areas, right? We're either, and I think Michael referenced this earlier, we're looking for acqui-hire, right? First off, because it's super hard to hire in crypto right now, right? It's much easier to acquire large groups of teams. The second is looking for tech, right? Because we're all sort of growing and expanding into new categories. And the third one is market share, right? So, continue to grow by, buying smaller competitors. So we tend to look at it more through those 3 lenses. And then, we've got kind of a deep M&A process, although we don't use a grade or a letter grade score. It's a good idea. We should implement that. But it's a little bit more bespoke than that. Maybe we're a smaller team.
Yeah, well, here we're all trying to come up and share ideas, make the space a little bit stronger. So I wonder, Michael, from your perspective, how is the process changing from the firms that you're working with, that you're advising? Are you noticing any differences, or are they adopting things like a grade? What type of nuance do you see?
I think the companies that we're working with, I would describe the fundamental change as really the tone at which they're approaching M&A, right? I think we're seeing, companies act significantly more aggressively in trying to build out their platforms. And I think the word platform is an important one, because we're seeing firms, who have specific, product expertise in one vertical, starting to say to themselves, okay, well, I need to build a large competitive moat. How am I going to do that? And the best means of doing so is creating product diversity, creating, these large, diverse platforms that enable them to, one, hold significant market share, and 2, start to accelerate, the adoption, more broadly in the space. And so, we're seeing across the board companies be more aggressive from an M&A perspective. And again, it's, I think we're seeing it, at like Sean's team and Lane's. It's not just one acquisition, right? It is really about putting together the ideal team, the ideal product portfolio, and building the right package to really, create that competitive moat and create very, very large, diverse businesses in the space.
What are the integration processes looking like? Or is that a challenge for firms, Steve?
I think it is. I think if I could, I'll just comment on something Michael said. One of the things I think is really interesting is, and I think he's spot on, we're seeing more acquisitions that are strategic in nature, that are complementary in nature than we did 2 years ago. 2 years ago, it felt more like, and this is probably an unfair comment, but it felt more like people wanted to invest to be in the space, right? There was a novelty, there was this wild potential upside. And now what we're seeing is that that's come back to, it has to be complementary, it has to meet the objective, it has to meet the need, and it can't be a one-time thing, right? We have to build an ecosystem in that competitive moat that Michael mentioned. So I think that's sort of number one. To your point, or your question, Frank, I think integration has been difficult. I think part of the challenge has been to carefully inspect what you expect, because most of the time when we're dealing with post-integration work, it's because there was a surprise somewhere along the way. There was a mismatch somewhere along the way that made things a little bit difficult, whether from a technology stack perspective or a personnel perspective, or a forecast perspective. And so to me, at least, the very first thing that we can do to start preventing some of that difficulty is being a lot more careful about looking for those synergies, pre-mapping those synergies, so that we have a game plan. When the acquisition is complete, we know what the integration strategy looks like, and we can execute on that.
How can one of those strategies go wrong?
Oh, sorry, is that for me, Frank? So
Sure, yeah.
Yeah, I mean, I think if you're not focused enough on those kinds of activities, and now you're trying to marry different technologies that perhaps weren't as compatible as were originally thought. If your go-to-market is lopsided, so one business has a completely different vertical that they're more focused on than you realize. So I think it's all about that diligence and understanding the business model, understanding how it fits the strategy, and then having a game plan for integration as you think about the deal and as you go through due diligence, rather than thinking about integration once the deal is closed.
And Frank, to Steve's point there, I think it's important to note that, when we're working with companies in this space, we're not typically going after a specific company, right? From an acquisition perspective, right? We're trying to solve a problem, or we're trying to bring in a certain product or a certain area of the market that maybe they're looking to expand into. And in order to do that, that means that you've got to do your homework, right? That means you've got to know all the companies in this that are actually, doing that one specific thing. You've got to understand the good, the bad. And ultimately, it's a matter of fit. And like Steve said, it's a matter of doing the diligence up front so that you know what you're getting, right? You know what you're walking into. And so from an integration perspective, there's a lot you can do to really hedge that and be in a position to feel like, you have a fair level of confidence going into it that you're going to have the right outcome.
And Frank, I would just add, getting into kind of the weeds on what the potential risks are. In traditional M&A and tech, you can diligence out most of the risk, right? There's not really a lot of question about whether or not a company's business model or products will create some sort of problem down the road. In crypto, there's a lot of questions with every company about what they're doing and whether or not it'll be considered legal or illegal in the future when regulations become permanent. Especially,
is there an example you can think of?
I think your example earlier talking about tokens. If you've got lots of Bitcoin or Ethereum on the balance sheet, I'm not worried about it. If you've got some random token I've never heard of, and you've got hundreds of millions of it on your balance sheet, do we want that? I don't know if we want that, right? It could come with all sorts of problems and risk, and so we really have to diligence that out. But you can't zero out the risk. And so I think that's where, if you're looking at where deals are going to go wrong, unfortunately, I think, for every sort of large company in the space, we'll make acquisitions now into next year and certainly into 23 that will end up biting us as we get 4 or 5 years down the road and regulation pops up that results in some sort of investigation or fine resulting from an acquisition you made years prior. That's unfortunately what's likely going to happen because the industry is still pretty nascent in regards to kind of what the risks are.
So how risky, how do you hedge that risk out?
Yeah, it's it's the cost benefit, right? So I think you have to be willing to take on a little bit of risk if you work in crypto, right? That's kind of why we're here. That's sort of what makes it exciting. But I think I think Steve and Michael both made this point pretty clear. Due diligence at crypto companies, and I think this is important for the folks listening who are interested in being acquired. It's not like we want to take a look at your cap table and your balance sheet and maybe a model and we're good to go. Our due diligence process can be several months long and it's very detailed, right? We get into every aspect of your business. We talk to sometimes almost every employee and we go several layers deep. So we do everything we can and note the folks we have doing this DD work have been doing it for years in other sectors, right? So it's not like, there's noobs trying to figure out how to diligence a company. So we are really doing it at sort of the most professional level you can. So it is a time-intensive process, and it is very thorough.
Definitely time-intensive. We've had this Galaxy Bitco tie-up in the works for almost a year now. What happens behind the scenes from the time at which it's announced a deal and then the closure date? What's happening in that process outside of integrations and that sort of thing, figuring out new titles, maybe. What's happening?
Yeah, I mean, Frank, I think you hit on all of it, right? I mean, the amount of time and effort that it takes to really integrate two large businesses like Galaxy, like Bitco, is very, very expensive, right? And we have literally dedicated teams on both sides working day in, day out, to understand what the business looks like when we finally come together. And it's very complicated, but the complication at the end of the day is what creates the opportunity for us. Right, when the decision to acquire Bitco is one because we believe there is just enormous strategic value and merit there, right? And so the challenge is now ultimately unlock all the upside that we see in the two businesses coming together. And so really our job is to make sure, like everyone on this call has said thus far, it's about doing the work up front to ensure the best outcome, once the two businesses come together. And so it's a ton of planning. It is daily updates. It is making sure that we're doing everything in our power to ensure, the right outcome once the transaction closes and the businesses come together.
I feel like culture is something that we haven't really talked about. There's an element of, if I acquire this company, is it going to help me launch a specific product or enter a certain market? Think something like FTX acquiring Ledger X to get derivatives to their users. There's also the element of an acqui-hire to sort of build out a team more quickly. Maybe the acquisition Coinbase made or announced last night might fit into that camp. So product, the sort of talent and what they can do are key considerations. But what about culture? Is there ever instances in which the people just don't really jive together? And then what do you do to make it more copacetic?
I mean, I can start. Culture is a huge element, Frank. And I think it goes back to what Lane and Michael were mentioning. When we think about the diligence process, diligencing the team is a key pillar of the diligence process, right? And so we want folks that are aligned with Coinbase's vision, share our kind of mission for creating more economic freedom in the world through this crypto economy. And so, we will hold extensive sessions with the leadership team and then key senior executives at the company to make sure that there is that really tight cultural alignment between the two firms, because ultimately people are a significant factor that drives the success of a lot of these acquisitions. And that's both from getting the deal done to ensuring that it's set up for success once kind of the deal closes and you're playing from the same team.
And Frank, people will leave if the culture is not right. Right. So it's, I mean, and Lane, you mentioned it earlier, you speak to, I think, almost every employee when you're going through that diligence process. I'm sure a lot of that, I don't want to speak for you by any means, I'm sure a lot of that is also understanding culture, right? Because again, when you're acquiring a business, you're not acquiring a business for a year or 2 years. The idea is that, the team stay on for the long term. And that means that people need to be happy. That means that people need to feel connected and aligned to the broader organization. And culture is the single largest piece to that puzzle.
Any thoughts, Steve?
Yeah, I was just going to say, thinking about people more broadly, unlike any other space, we see diligence include people more meaningfully than anywhere else. And that includes more official background checks, verification of capabilities and skill sets. When we have technical people, what are those technical people really doing, and what's their skill set really? Not what their resume says, but what are they capable of? What's the R&D roadmap look like? We're buying a business that we don't want to be obsolete in 3 months, and with things moving and changing so rapidly, we're often asked to look at what's the R&D roadmap look like? Are we ahead of schedule? Are we behind schedule? Are we in 6 months still maintaining our competitive position, or are we struggling here? So I think people broadly has been a much bigger focus in this sector than anywhere else we've seen.
Is it different in different geographies?
Yeah, so blockchain has employees in 22 countries, right? So defining culture as any one thing is pretty complicated. And then you layer on top of that the fact that we've got employees that are crypto native, although those become unicorns now. There's not many crypto native folks anymore to hire. And then you've got people who come from tech. and then you have people come from finance, right? And those are three very different cultures, right? And then you have the company's culture that's being developed itself. What I've found is I've visited the various offices around the world and spent time with teams in those regions. The culture does sort of fit that idea that you are believing in something bigger. You believe in the future of the company. You believe in crypto being the financial system for the internet, and so you do have that shared passion. But then when it comes to sort of the day-to-day dynamics of how the office works, if they're in the office or the virtual office, that really does vary. Some teams like get together more often than others in person. Others, like in the Bay Area, I mean, I'm maybe 2 miles from one direct report and maybe 3 blocks from another. I see them on Zoom every day, and I see them in person maybe once a month, right? So I think it just depends on the region, and we allow for that.
Makes sense. It's definitely strange in this, COVID remote world to execute a deal. What factor does that have on, trust, sort of making something happen, and doing the proper due diligence? Does it play any role? Does it make it any more difficult, Michael?
I think it certainly adds a layer of complexity that we haven't seen before. But I think there are a lot of the deals that we see getting done are done between companies where there is some sort of pre-existing relationship, right? And so there is a shared history of some sort, so that you do have context and you do have a level of confidence. With that said, there's a lot that we can do now to get smart very quickly, regardless of whether or not you're able to get in front of someone face to face. It's still, at the end of the day, in our mind, something that's very useful in the context of M&A, because M&A can be difficult, right? These negotiations are not always easy. And so, being able to have that sort of eye-to-eye contact can actually pay dividends. But I don't think it's a requirement. We certainly not see it be a hindrance to getting deals done. I think to Steve's point, there is a lot you can do, from a people perspective, to get comfortable from that more extensive due diligence and background reports and all that fun stuff, so that you feel like you're in safe hands, even if you're not face to face in an office with someone, having that conversation live. But it certainly does add a layer of I don't want to call it complexity, but it's another layer that you have to think through when actually understanding whether or not you're going to be able to find the right marriage between two businesses.
Makes sense.
I will say too. Sorry, Frank. I will say too, this is a little bit unique, right? Because we're dealing with titans in the space here. I mean, my 3 colleagues here are, to Michael's point, well-versed, well-educated, familiar with the sector. The majority of the deals that I touch don't have that mix, right? I mean, we're dealing with venture capitalists, private equity. We're dealing with small companies buying other small companies. And so I think it's interesting to hear the difference in maturity and the way that the folks on this call look at those kinds of issues versus what some of the smaller team members are looking at. And so if you're on the call listening in and you're not one of the titans in the space, even more so important to pay attention to the kinds of characteristics and attributes that we're talking about here.
Guys, what happened to SPACs? Is that something that we should still be paying attention to? Is it a viable transaction or route for a large crypto firm, or are we over the SPAC crypto mania?
I think SPAC is a 4-letter word now, Frank. I'm not sure we're allowed to talk about those anymore. Look, my take on it is the SEC is not super interested in any more crypto companies necessarily going public via SPAC. Certainly, I mean, just not interested in any companies going public via SPAC. It seems like they slowed down the process quite a bit. I don't think it's dead, but I think the frenzy we saw in Q1 is in the history books. I don't think we're going to see the same type of intensity around the public process. And partially we're seeing folks struggle to raise a pipe, and it's because there's questions about their business model. Maybe they don't have, audited financials, or maybe they haven't actually produced $1 of, profit since they've been in existence. And I think when there are better options to invest in the public markets, like Coinbase, for example, then, why would you bet on something that's a little unproven? That's unfortunately a lot of what we're seeing in the SPAC world. Now, that said, there are, I think, a couple of really impressive companies that are still pursuing the SPAC route, but unclear whether or not they'll be successful. The SEC has not been very clear on how they're going to treat crypto companies in the SPAC world in the long term.
I think Lane's right. I think you hit on something interesting, Lane, which is, in my view, generally speaking, like put aside crypto for a second, the SPAC market in general, I think is moving towards a more mature target profile, right? I mean, we saw last year, companies with ideas, get valued at billions of dollars, and some didn't work in a very public way. Others might not work in the future, right? At the end of the day, these are effectively VC stage companies that are going public and now having to answer to public company investors every quarter, which is really, really difficult, and not an ideal way to grow a business. And so I do think, like, more generally speaking, we're going to see the SPAC market succeed when it comes to companies and targets that are more mature, right? That have proven out their product, that have proven out their business, have real revenue and real EBITDA, and can point to a past operating history as a means of saying, hey, we're gonna be able to do this next year and maybe this the year after. But I agree. I think there still is a bit of uncertainty around what that means for crypto companies specifically. It's certainly something that we're watching very closely, and I think it is going to be particularly hard in the very near term because we're seeing almost nothing get done from a pipe perspective. And ultimately, that has been, I think, the largest hindrance to things moving forward. And in some ways, it takes away the benefit of the SPAC, which is really to fully capitalize the business at inception, right, at that public market listing. And when you take that away, it just, the value prop, I think, changes materially. There are certainly ways around it, and we're seeing that active in the market today. But we'll have to, pay close attention to understand if these other alternatives are really doable and achievable, and if they have any longevity.
Steve, are fewer companies maybe engaging with you that are thinking about a SPAC, or are you seeing less folks considering that?
Definitely less considering it today than a year ago, for sure. And I think, look, Lane and Michael were 100% spot on. And Michael's such a smart observation that moving from, culturally, in a business operations perspective, the smaller player to now suddenly all of the requirements that come along with a publicly traded company, very difficult for people. And you talk about retention and you talk about longevity, it makes things really, really difficult. And Lane, you're spot on. I mean, how crazy is it that in essentially one comment, the SEC can change the entire dynamic of our business models, right? And our approach. And I just think
that's trying to protect us.
It's absolutely amazing how that can happen. And look at, mining in China, for example, and the boom there. And then of course, the flock to the US, and then people saying, whoa, wait, you can't be a Chinese owned company and operate in the US. And so now sort of moving to Canada. I mean, all of those things, that, to our whole point about risk and understanding the business and the business model, there's no way to foresee what might happen there. But you have to be able to understand the potential risk, and you have to be able to make decisions accordingly. And I think with SPACs, my colleagues are right. Definitely slowing down. We do still have a couple in the pipeline that we're tracking right now, but I think you'll see a lot fewer of them.
Shan, I want to get your perspective as someone who works at the largest publicly traded company in crypto. Has that process made it easier, or rather, does being a publicly traded company make the acquisition process harder or easier, right? When we think about what that stock is, a currency for acquisition, that's one of the touted benefits of being a public company. You can use this as a form of currency for M&A, or is it more difficult? How do you sort of look at that?
Yeah, I would say it's definitely, I feel from a currency perspective, it's gotten easier, right? Like there are no debates as to what the value of Coinbase's stock is. It's publicly there. We can debate as to what the trajectory of that is, but everyone will have their own views. And so, I recall in, 2018, 2019, establishing and agreeing upon a value for private shares can take a lot of work and a lot of back and forth. And then, especially as the potential acquirer, there's an element of diligence, but then there's reverse diligence for the seller as well, right? And
Sure.
So, now being a public company, all of our information is very readily available. And so those conversations, we just skip over them, right? It's very easy. And so that has definitely streamlined things in a lot of ways. From an operational perspective, to be honest with you, it's largely business as usual. What I always say is, we basically were operating like a public company for at least a year before we ultimately did go public. So in terms of our M&A process, the stage gates that we have as we go through approvals, the type of diligence that we do, how we think about integration planning, yes, it's matured just as the business has matured and our teams have matured, but it's largely the same as it was when we were a private company.
Michael, you're in an interesting seat, right? Because you have a business, right, that's kind of acting as an advisor, but then you're also doing M&A internally, right, for the firm itself.
Yep.
Does that give you some sort of upper hand? Are folks sometimes afraid to maybe be acquired by you because you've got this potential insight or advantage?
Look, I think first and foremost, our job is to be client focused. And so I think it's very important that we continue to separate what we do from a client perspective with what Galaxy does as a broader company, right? And so we have those defined lines in place so that our clients have all the certainty that they would need to gain comfort that, there isn't some arb being played here between us, Galaxy, and this client. And I think those lines are really important. And look, that's true for a number of companies in the traditional finance world as well, that they need to obviously figure out. And so there is a defined way to do that. And I think we do a really good job at it. What I would say, though, is it obviously does afford us, a lot of visibility and intel as it relates to what's happening in the market, who the key players are, what the different, macro sort of factors are that are driving different things in the market. And so from an information perspective, I think that affords us a great deal of unique insight and visibility that we can leverage for our clients.
So what are some of the macro factors that are at play when we think about the next 6 months? If we're in a prolonged bull market, how does that shape the way M&A is going to play out over the next 6 months? Shan?
I think I would go back to the discussion that we had where Lane and I were just saying, a lot of this has actually been ongoing now for the last 2 to 3 quarters. And so if we're in a prolonged bull market, what I would just expect is that it sort of continues to roll forward. So rather than a lot of activity starting in Q2 and then you're hearing announcements in Q4 and Q1, you'll continue to see a lot of activity up until, call it Q2, that will carry us through the end of 2022. On the other hand, I would say that for companies that are established like a blockchain or Coinbase, where we're taking a really long-term view, my feeling here is that even if we are to turn into a bear market, at least I can speak for Coinbase, we're going to continue to be acquisitive, right? Because we're not thinking about the next 6 months or 12 months. We're taking a 5-10 year view on where the space is going. And one of the benefits of being a public company is we have broader access to capital, and we've tapped that a few times now that we've been a public company. And so part of that is so that we can weather the cyclical patterns that exist in crypto and continue to just execute on our strategic priorities.
I also think it's interesting to mention that the companies, I think, we're just starting to see companies think about defensive capital raising, right? Like if there is concern that maybe a bear market is coming, companies looking to raise capital today to, one, find themselves in a position where they can weather that storm, and two, can then opportunistically, look to acquire businesses that maybe aren't as well prepared to withstand any sort of market turbulence. And so I don't view that necessarily as an indication for what we can expect from a market perspective, but it is interesting that we are seeing companies today position themselves in advance of that potential down market.
Yeah, I mean, Michael's being very eloquent. Like if there's a down market or a crypto winter, like there's going to be a feeding frenzy, right? Yeah. Like the companies on this call, like we're going to go crazy because what will happen is venture capital will dry up for all of those companies. So anybody who needs a bridge or a subsequent round of financing because they have a good idea but are still kind of struggling with product market fit, they'll all of a sudden find themselves in a very, very bad scenario where they're making calls to every banker that'll take it to try and shop them around to folks like our shops, and it'll happen very, very quickly. So those frothy numbers will come down out of the stratosphere. So not that I'm hoping that'll happen. I want it to continue. I want the market to stay up, but if it happens, the dynamic will be fast.
Either way, the house wins, right, Steve?
No doubt about it.
What about the guidelines around or the parameters around deals? We kind of touched on it, but maybe to just really dig into it, right? There aren't things that are as clear as like, gap guidelines or parameters around the normal processes of how you get a deal done. And there are these different risks, but are things becoming more clear? Is there more clarity around how you can build these models and understand the value of a given company? Michael?
Look, I think in some ways it's not too different from, just M&A more generally. I think it's a pretty well understood process for how to go about, executing these the right way, how it is to identify the right opportunities. There is obviously a certain level of complexity and nuance that lives within crypto, which is unique to crypto, right? And I think our job is to be able to help companies, whether they're crypto companies or candidly, TradFi firms that are looking to move into the space in some way. It's really bridging that gap, right? I think fundamentally things are the process is very similar, but it's really about the education and making sure that everyone is speaking the same language and we understand the nuance and we understand like the idiosyncratic nature of a number of the companies that, we work amongst on a regular basis. And so I think it's really about just education, being really thoughtful, understanding what makes each of these companies unique in order to facilitate the best outcome.
Steve, what do you think?
It's the old adage, inspect what you expect. The models are definitely getting very clear now. I remember years ago doing due diligence on the first Bitcoin mining operation in our business, at least. And it was difficult, right? Because there were so many variables that you had to really think through and make sure that your client, the acquirer, fully understood and appreciated. That's not the case anymore. Now, we've all done due diligence on a number of different types of businesses in this sector. And, we can use those templates, we can use those lessons learned and make sure that we all really go in eyes wide open and understand what those risks are, understand the nuances, and make really smart decisions.
Is there more clarity from your perspective, Shan?
Emerging. It's certainly not, I would say, like a traditional mature industry by any means. But yes, right. You have, if you go back 3 years ago, there really weren't even very many traditional growth stage companies in the crypto space. Now you have multiple publicly traded crypto companies. You have a new billion-dollar crypto company every other week. And it's more than just Bitcoin. There's Ethereum, there's many chains, there's staking services. There's the industry growth is just, it's kind of breathtaking to take it all in. And so we have a lot more pattern recognition than I would say we did 3 years ago. But I would not characterize it by any means as mature if looking at, a publicly traded company that has been in an industry for over a decade.
There's something like 70 or so crypto unicorns now. I mean, that's pretty unbelievable. That there's going to be a compounding effect, right? When you have companies that are worth this much, that value, whether it's through M&A or through venture, is going to recycle into the system. And so I wouldn't be surprised if it's sort of, if there's a compounding element here. But who knows? I might be wrong. What do you think, Lane?
I think you're right, Frank. There was a question I was kind of glancing at it in the chat here about, what do you think about Softbank being in the mix? And I think whether it's, Softbank investing into crypto, whether it's Tiger, any other major venture firm, pretty much everyone in the Valley, A16Z has been at the forefront for a while. What does this say? It's legitimacy, right? And it's proving that the sector isn't an F, but a win. And we're seeing this reflected with regulators taking the sector seriously and trying to create a permanent regulatory framework, whether we agree with it or not. We're seeing it because the pipeline of companies that want to be acquired is growing every day, right? And I'm sure all the folks on this call are getting hit frequently by companies that are looking to be bought. It is a recognition that it's not an if anymore. And so I think it is pretty validating.
Okay, but is there interest in acquiring, let's say, a data and information services company?
So from our M&A perspective, we're interested in everything, not just crypto companies, right? So, and that's because the nature of our business, right? We need actuaries and accountants, and we need public relations professionals and policy folks. So, we're interested in everything. And if it's a good deal, a great team, then give us a call.
Yeah, and then Frank, to your point on recycling and kind of compounding within the space, it's part of the reason why we started Coinbase Ventures in 2018, right? I mean, Coinbase was one of the earlier companies to get bigger. We started Coinbase Ventures, invested in small early stage companies, right? And the hope there was just to help the whole ecosystem grow. As those companies have grown, we've seen those companies are now acquiring other companies. Those companies are investing in other companies, right? And so it does start this virtuous cycle that we think will help the broader crypto ecosystem grow overall. It's going to benefit Coinbase, it's going to benefit blockchain, it's going to benefit every market participant.
Yeah, I think to Sean's point, I think you'd see all of us on the cap table of companies throughout the space, right?
Sometimes companies are investing in each other. I think I've seen that once or twice, kind of like a human centipede situation.
Yeah, every day.
I was hoping we would get there, Frank.
Yeah, well, if there was any better way to conclude the conversation, ladies and gentlemen, thanks for sticking around, and we'll have to do a part 2 in 6 months to see how our predictions played out and touch base on what might have changed at that point. Everyone's coming in, they're thanking us. You're welcome. Thank you, really. Let's see if there's any questions from the audience that we might want to include. A lot of Softbank talk, a lot of metaverse stuff as well. This is a great panel, gentlemen. Steve, Sean, Lane, Michael, thanks for joining us. It was a lot of fun. Talk to you soon.